Good morning and welcome to iBanker News today, this Sunday, February 1st, 2026. Comment of the day goes to TBadJ649, who says, and I read, regarding silver, would you be able to do a deep dive on COT reports and CME inventories? It's hard for the average stacker to gain transparency and distill this particular trading activity in silver. Ooh, we really like this one. Thanks for the idea. This is right up our alley, wonky, and it's going to come with a triple helping of snark. Here we go. Today we're going to talk about numbers, at least the ones that actually matter. Not the headlines, not the price targets, not the reassuring nonsense from people whose bonuses depend on nobody ever asking for delivery. But the plumbing of the COMEX silver market, the COT reports, the inventory math, and why March 2026 is where the whole routine gets uncomfortable. Because once you understand how the markets work, you realize something very quickly. This isn't a mystery. It's a system that only functions if people agree not to test it. Let's start with structure. On COMEX silver, only 5 months matter from a delivery standpoint. March, May, July, September, and December. These are the primary delivery months, the ones that actually carry volume, open interest, and, in theory, the obligation to deliver real metal. Right now, everything centers on SIH 26, the March 2026 contract, and the calendar is brutally simple. February 27, 2026 is called First Notice Day. This is the most important date in the entire cycle. From this point forward, delivery filings can begin. And if you are long the March 26 contract, after this date, you no longer are holding abstract price exposure. You are exposed to physical settlement mechanics. This is the true start of delivery risk. Everything before this is theater. Throughout March, delivery can occur every business day. The first delivery date is March 2nd. Metals can actually move. Bars leave COMEX-approved warehouses. Inventory becomes real. Now, March 27th is the last trading day. After this date, the contracts can't be traded, and any position left is committed to settlement. So March 31st is the last delivery date. It's the end of the line. So now let's talk about whether the silver is actually there. According to COMEX warehouse reports, registered silver, the only category eligible for delivery, sits at roughly 113 million ounces. And this is where the business press usually stops thinking, because on paper, March open interest represents roughly 500 million ounces of silver. So if you divide the 113 by the 500, you get roughly 22.5%. And that's usually where someone on television says, see, plenty of coverage. Then they not confidently move on to talking about rate cuts. But here's the part they never explain. Registered does not mean available. Registered silver simply means the bars that meet COMEX's specs that could be delivered if the owner chooses. It does not mean the owner wants to part with it, that the owner isn't hedged elsewhere, the owner isn't a bullion bank defending inventory, or the owner hasn't historically never delivered an ounce. In other words, a meaningful chunk of registered silver is theoretically deliverable, though practically immobile. This isn't controversial, this isn't fringe, this is how the market has behaved, and for decades. Which is why analysts routinely discount registered silver to estimate what's actually available under stress. The discount is typically somewhere between 25 to 40%, and it's based on ownership concentration, historical delivery behavior, repeat patterns of metal that simply never moves. So let's be conservative, take 113 million ounces of registered silver, apply a 35% haircut, and that leaves roughly 73 million ounces of what's called available registered. 73 million ounces against over 500 million of demand. So let's redo the math. 73 divided by 500. That gives about 14, maybe 15%. So here's the honest framing, and here's the part that never makes it onto a Bloomberg Chiron. Headline coverage, 22 to 23%. But stress-adjusted available coverage, 14 to 15%. Both numbers are real, but only one reflects how this market actually behaves when somebody asks for metal instead of cash. And here's the part that really matters. Even 22% coverage, the high number, is fragile. You do not need everybody to demand delivery. You do not need a panic. You barely even need enthusiasm. Historically, single-digit percentages of long standing for delivery are enough to force inventory reshuffling, lease rate spikes, and emergency incentives to cash settlement. But now, layer in commitment of Traders Report, the COT. The COT shows commercials, bullion banks, large dealers, still heavy net short into this delivery window. Managed money has always been partially flushed out by volatility, margin hikes, and sudden price reversals. Sound familiar? This is the rinse and repeat game. Commercials sell paper into rallies, funds chase momentum, volatility spikes, stops get hit. Seems like we saw this one very recently. And who ends up holding the bag? It's always the same crowd every time. Managed money funds forced to puke longs at the lows, CTAs, or commodity trading advisors, whose models flip at exactly the wrong moment. Retail investors via ETFs who thought they owned silver, and occasional miners hedging forward at the worst prices imaginable. The commercials quietly cover, reset higher, and the cycle continues. And the business press reports this as volatility or profit-taking or healthy market function. Not once do they ask the obvious question, what happens if someone doesn't roll? Because that's when price risk turns into delivery risk. Once February 27th arrives, shorts face assignment risk against the inventory base that can realistically cover maybe 14 or 15% of paper claims without stress. At that point, the system has three options, none of them pretty. Option number one, drive prices higher to coax metal into registered. 2, scramble for leases and swaps at ugly rates. Or 3, and this is the most likely, quietly encourage cash settlement and call it orderly. And if March settles largely in cash, the implications are unavoidable. This is not physically settled market. It is a derivatives market with optional metal delivery. COMEX futures prices after this represent little more than a giant suggestion box, which is fine as long as everyone is honest about it. But honesty is not the business model here. The inventory tells you what exists, the COT tells you who's exposed, the calendar tells you when excuses expire. And for SIH 26, that countdown starts on February 27th and ends on March 31st. The story isn't ignored because it's complicated, it's ignored because it's inconvenient. And math, unfortunately, does not care how confidently it's dismissed on television. Thanks for watching all the way to the end. We hope you found this informative and enlightening. Join us tomorrow when we examine China's market response and COMEX and LBMA's reaction. Buckle up! It's going to be really fun these next few weeks, and we'll be here every step of the way to interpret just what in the world is going on in silver. Until then, take care of yourselves and each other. Build that